Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the bond market, mortgage rates, and jobs data, which we're going to get a lot of this week. Before we jump in, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
2026, brand new year. Boy, when we thought was there going to be less drama in 2026? The first weekend was like, holy Toledo, we did Jack Bauer, get in there, get Moderno out and bring him, it's kind of reminding me of the Batman movie where they went and got the guy from the tower. But yeah, it's nothing's ever normal, Sarah. After post-COVID, every year is wild. So we started this year off with a bang.
You know what? That is a great thing. Nothing is ever normal. I know I called you several times this week and I was like, okay, wait, what about this? So for our listeners who don't know, I write a newsletter 3 times a week for our subscribers, and I'm often calling Logan and getting his latest on like, okay, what happened? So yesterday I called you. I was like, I'm going to send out something to our subscribers talking about what they should expect with mortgage rates. Was this military action going to cause something in the bond market? So they got that early. And what did you say, Logan?
Yawn.
Yep.
Nothing, and it's interesting. We kind of talked about this like 10 days ago or something, where you said, what if we go into Venezuela?
I did.
Nobody's going to really care. So things are a little bit different now on the geopolitical world of things and market related. This one, what does it really mean? I mean, oil production was low in Venezuela. The oil blockades will let some oil out. It'll take time to get some production out there. So again, that would be, a disinflationary event in time when it happens. But you and I talked about this, November of 2024. What's the Trinity effect? What does Trump need? Number one is low oil prices. Like, they really believe if oil prices go lower, everything else follows. And this is just another version or another tactic in that game plan out here.
Yeah, when I asked you a couple weeks ago, and even when you wrote in your in the HousingWire 2026 forecast, you had the X factor. You're like, here's where you set a mortgage rate range, you had mortgage spreads, you had home prices, inventory, all these things, and then you're like, the X factor, and the X factor is the Trump administration housing policy and/or geopolitical events, right? That might happen.
Well, with housing, it's really the Fed. What's really going to happen? We've never had a active sitting president install his own people at the Federal Reserve, and then try to make policy out of that by not just the head. Of course, the Fed chairman himself can't do it, but getting enough votes out there. So again, we take it one day at a time, but there's been a lot of crazy stuff every single year now post-COVID. Just have to learn to adjust and try to monitor it and model it out as best as possible. But the Venezuela thing, just didn't think that was going to be a big issue either way.
Well, that was good news. As you told me yesterday when I asked, you're like, normally the markets would respond, right? A flight to safety into bonds if you have this sort of thing. But in the last year, especially, there's been so much happen that we just don't see that reaction anymore.
No, I think, what's the last geopolitical event that escalated into something really big? The Russia invading Ukraine did. It shot energy prices up. It also shot wheat prices up, and wheat prices really matter, actually. I won't get too much into that, but outside of that, Iran, Israel, Venezuela, these things just don't generate anything big. Now, typically the response of money would go to the dollar, the U.S. bond market. That's the safest place to park any kind of thing. But it just, oil didn't do much. The 10-year yield is just 1 or 2 basis points back and forth, so not much happening. But it is jobs week. That's the thing that can do everything.
Well, of course, I was going to ask you, labor over inflation. So you mentioned one thing about, longer term, if the United States has access to more oil, that's disinflationary, right? So we do have that potentially coming in for inflation, which would be great for the housing market. What about jobs? Where are we on jobs? Because we know that's going to drive a lot of what the Fed's going to do.
So last year, for anybody who's new here, last year the 10-year yield was elevated 470 in that area. Mortgage rates got as high as 7.26%. But, labor over inflation, the reasons why people thought mortgage rates would stay elevated or even go higher is a list of reasons. Number one, inflation was rising. This is true. It rose. Didn't matter. Number two, we are a broke country. We can't support our bond market. That's always been fun for me. Oh, by the way, for the gentleman who said that the 10-year yield will never be below 5% after October 2023. Chef kiss, baby. Number three, we have so much treasury supply. This one got a lot of people. That there's absolutely no way in the history of America that we could have that much debt come onto the marketplace and not have the 10-year yield go much higher. That didn't work either. But what did work, Sarah Wheeler? What worked is that the labor data started to get softer. The Federal Reserve kept on saying to people, oh, the labor market is robust, solid, everything's good. But their unemployment rate target was like 4.3% going into 2020 or 2025. If it goes above 4.3%, then, they said this might be an issue. Well, as the year progressed and revisions were negative, remember, Team Logan was Waller and Bowman and everybody saying the labor market is softer than what the Fed believes, right. Policy is too restrictive. Well, when it was all said and done, the 10-year yield is at the bottom end of the 2025 forecast. We really shouldn't go lower than the Hodor line based on Fed policy. We have 1.75% rate cuts into the system. We have just a few more rate cuts tagged in. And then we take it from there. But the labor over inflation model already ran its course based on Fed policy. It's really hard to get under 380 and have the 10-year yield go lower and mortgage rates go lower based on that if they stick to this. So that worked. But now what? Now what do we do from here?
Now, what do we do? Because we know we're going to have, Powell's term is up in May, right? And before that, we've expected before now that Trump would name somebody, which will already influence policy. He's also going after Fed governors. We'll find out the Supreme Court is going to hear the case against Lisa Cook, or not the case, but hear whether it's possible for the president to fire a Fed governor for cause or otherwise this month, although we don't know when we're going to get, the opinion on that. But there's a lot of things in play with the Federal Reserve. You still, though, on your forecast, feel like your mortgage rate range has taken all that into account, and you don't see like some going off a cliff in mortgage rates because we have a new Fed chair.
No, because put it to you this way: if hypothetically, let's just say President Trump gets Kevin Hassett in. For some reason, he gets enough Fed governors kicked out, and he's got his own people. It still becomes how is the bond market going to do if labor data starts to improve? Because the bond market, I thought, and this is a very good topic for everyone because this rarely gets talked about. Everyone talks about, well, when the Fed cut rates, mortgage rates went up. Nobody wants to talk about that mortgage rates made a 2% move lower without any rate cuts. So
before that is what you're saying.
Before that, everyone just forgets about that. So what occurred was the bond market broke the Hodor line, which it shouldn't have, but it did. That's the 380 on the 10-year yield because the growth rate of inflation was falling and jobs data was getting much softer. So they assumed that the Fed was really behind the curve. Well, after September of 2024, the data started to get a little bit better. November and December jobs growth was 260,000. So rates shot back up as it should. Because policy was up here, the bond market was up here. They have to converge, or one has to go up to the other. Now it's different. But even with the lowest job growth in the 21st century, even with the unemployment rate rising, the 10-year yield is not breaking under 380 because Fed policy is trying to just get to neutral. Right? They're pricing out neutral already, but it's just hard, in that sense. So a few things have to happen. The case for rates to go up higher is the 10-year yield starts to see economic data improve, growth picks up, unemployment rate goes down, job growth is above 50,000, Powell's line in the sand. And with Fed policy, getting 20 or 30 basis points higher from here is not abnormal. I only have a 460 level on a peak now. I took 0.5% off mortgage rates. Like I don't have a 7 handle anymore in any forecast because the spreads are better. By the way, spreads will be the next topic. But So we have to see how the bond market now reacts to all this data when we're down here. Like, I like to protect my edges on the top end and on the low end. So I'm protecting my low end right here. So I'm telling everybody, let's see how the bond market reacts to all the jobs weeks from now on in 2020, no matter what happens with the Federal Reserve, because policy is now properly priced for getting to neutral with the labor market getting softer.
Whew, okay, well, so this week we should get some jobs reports, right?
We should get them all. They should all be here. BLS, Jobs Friday, ADP, job openings. So we're here now, and I think again, bond market, how the 10-year yield closes on every single day, how it reacts to the initial headlines, because we had a very soft labor market last year, and we still didn't break under 380. That the bond market is telling you something. We're going to hold this line. Hold the line. What is it? What do we always do? Gandalf, 2023. Yes, Gandalf, hold the line. We're not going to, that was 2023. 2024, the Hodor line. Now, good battle, right? Good battle, because we're on the low end. If labor over inflation matters, let's see how the data goes. Now, if jobless claims are breaking, end of story, right? Fed's behind the curve. They got to get more. They got to talk about an accommodative stance. They've never done that. So until then, let's just work off what the bond market does every single jobs week, especially the first 6 months of the year, to see where we're going to go with the 10-year yield and mortgage rates.
This week we get jobs numbers, but because it's, the last weeks of the year, you have some screwy data in there. Do you feel like this will really give us a good idea of what's happening in jobs? Or is this another one like, okay, yeah, that's December and that's the last weeks of the year, and now we have to wait till the January numbers?
I think with the government shutdown, things are always going to be a little bit off until we get into the future, right? And I think January, February, March data will be a little bit more clear. But one of the things that I really want to see is if the labor force starts to pick up, the unemployment rate has a potential to like 4.85% this year. Because the labor force growth was slowing down, it prevented the unemployment rate from going up higher last year. It could have been 4.85% already. So what does the Federal Reserve say about that? Because the Federal Reserve could come out and go, well, the unemployment rate is up because the labor force growth is up. Homie, that's not working anymore. You could have got away with that in the past because job growth was 160,000, 200,000. That's fine. But you can't say that anymore with the 21st century lows in jobs. So that's one of the things that I'm keeping an eye on is if labor force growth does grow and the unemployment rate keeps on rising, how does the Fed and the bond market react to that? And now that the government shutdown and all that stuff is over, the first 6 months of the year is just going to be a little bit more cleaner data.
I think the crazy thing is last year, the Fed was okay, or at least Jerome Powell was okay. If there was no job growth, if it was like zero, that he was like, yeah, that's okay.
Probably one of the things he shouldn't have said was that we could have 0 to 50,000 job growth and that'd be perfectly fine. That's just not, no, that's we have more unemployed workers than job openings. That's the Fed. The Fed loves the job openings data. I know a lot of people hate it. I love it. The Fed loves it. So they can't use that anymore. So I think, he tried to reverse that statement and say, okay, 50,000, that's what we call the, what's the run rate between population growth? Like, what do you need? The Fed doesn't know exactly what the number is out here, but, I can tell you this, you get 100,000 job growth with the unemployment rate falling, the Fed is going to say, hey, listen, the labor market isn't breaking. Jobless claims is still the key thing to everything. Jobless claims has never broken, really. I mean, you take COVID out of the equation. Since 2010, we've never had a really break deviation on jobless claims. So we always focus on that data, but right now that data is still, that got very screwy at the end of the year. I think we're under 200,000. There's some seasonality factors, but it's very interesting because there's all these structural dynamics with the labor market and the Fed and with the bond market. But again, always remember, labor over inflation won last year. We had tons of reasons for that not to work, but it did. But now we have to think about it because we're down here, man. Again, that Hodor line, really, if it wasn't for the bond market freaking out that we had a recession and everything in 2024, Hodor line should not have broken, but it did, shot right back up, and now it's different. I encourage everyone, go take a look at the 10-year yield from January of 2024 all the way to January 2025. take Godzilla tariffs out of the equation. It's been slowly moving lower and lower and lower and lower. Job data slowing down, labor or inflation went, but now 2026, much different.
Okay. And the hero of 2025 going into 2026 is
mortgage spreads. We got to 2% now. Now, normally mortgage spreads in recent history, not going back decades, 1.6 to 1.8, we're almost there, right? We closed the year off at 2%. That means we have 20 to 40 basis points lower left in mortgage spreads to get, back to the normal range, which hypothetically, if we're using a 620 mortgage rate's 6% to 580. This is why I always say that I can't really get below 5.75 unless I have normal spreads or a Fed getting more dovish. But we're not that far off. So in 2026, it took a while, but we finally got mortgage spreads close enough to the norms that this isn't going to be that much of an issue. It also means that it's very, very hard to get mortgage rates above 7% again, unless the labor market starts to explode higher and does much better. The spreads are breaking down and making the volatility in mortgage rates much lower now this year, which is a positive for everyone.
Huge positive going into 2026. Okay. I would encourage everyone, go back, listen to our podcast about the HousingWire 2026 forecast. Go read it online. It has a lot more detail on these specific things, and sign up for the Housing Economic Summit on February 10th. Logan's going to be there in person. He's going to be on stage with Barry Habib. We're going to have Mike Simonson there. We're going to have Jessica Lotz there. We're going to have so many great economists all in one place, all in one day. It's going to be amazing.
Yes, get all the nerds in one place. Revenge of the nerds.
Revenge of the nerds. That's what this is. Okay. Logan, thank you again. We'll talk to you soon.